So, hello and good afternoon here from Berlin, Germany. The first time in 2019. I wish all of those listening to me right now here live, but also watching the recording of this webinar here, a happy new year and lots of points and pips in the markets. Happy trading. And yeah, I just hope that you had some nice days off, if there were some nice days off, to be honest, because over Christmas, but also in the period between Christmas and New Year's Eve here, we just saw some wilder swings in U.S. equities, thanks to the developments we currently face in the U.S. with the shutdown there. My personal opinion is, in fact, that somehow it seems as if Donald Trump is losing somehow not just the support of many of his former supporters, but it's also as if he is probably losing some control, in fact. So there were some developments. Okay, it was his U.S. Or it was the U.S. Treasury Secretary Mnuchin here, who came out with the call to the I think 6 or 7 big CEOs from the Wall Street to make sure that they have enough liquidity just in case of bigger swings and markets here, and being well prepared for such developments here, and that he was in talks also with the plunge protection team. Stabilizing the markets, stepping in as a buyer. We've seen that on the 26th of December with a 1,000 point move in the Dow Jones, for example, the biggest of such a one-day intraday point move ever measured. Before, on the 24th of December, we had the biggest drop on Christmas Eve here. So the thing is that this is not showing some good feeling for the market or the psychology of the market, and this is worrisome, let's say. So we want to have a look at all this in the following 45 minutes. Probably get an idea of what to make out of it, if there are chances to make something out of it, what developments we have seen over the days in the markets. So 2 days ago, Wednesday, there was a flash crash in JPY crosses. Today is the non-farm payrolls, also very interesting after yesterday's ISM data coming in with a 1-point drop, the biggest month or drop on a monthly base, in fact, here since 2008. That was the last time when we saw a big recession. Before that was during the new economy bubble, another recession. So there's plenty of things we want to focus on here, give an idea of what to expect in the week to come. But before we start, first of all, as usual, the risk disclaimer here, very important. Make sure that you understand that trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. Everything else around this risk disclaimer here, you can find it in detail on the website from Admiral Markets. So please feel free to check out the website. We want to dig a little deeper in a differentiation between retail clients and professional clients from August 2018 onwards, the so-called ESMA decision. Based on that, it is that the ESMA decided to restrict the offered leverage for retail clients by a max of 1 to 30 for Forex majors like Euro USD, Dollar JPY, and 1 to 20 for other currency pairs, so-called minors like, let's say, GBP, Australian dollar, for example, but also CFDs on indices, in this case, or in our case, especially the DAX or gold. And there's something else very interesting here. There's a negative balance protection for those retail clients. So now the interesting thing is that professional clients do not face such a leverage restriction. So if you're a professional client, the criteria you have to meet here, please feel free to contact the customer support in your respective language directly to get all informations there. Probably you want to apply for a recategorization as a professional client because your, let's say, trading approach, for example, needs a higher leverage. And that's why you probably say, I can't work as a retail client here. So in fact, there are trading approaches which work with a higher than 30-to-1 leverage, even though in my trading, for example, doesn't play such a big role. But I know several guys in which case this is important. But there's also the negative balance protection in this case. So many say they want this protection here in case of being a retail client after ESMA. There's now a limited protection against negative balances. For professional clients, Admiral Markets is offering something very interesting here too. They offer a negative balance protection up to £50,000 sterling, according to their policy. Also here, feel free to contact Admiral for further details on this topic. So this is me, the guy speaking here to you, and your question now might say, okay, why shall I choose Admiral Markets as my broker? Here in Germany, we refer to Admiral Markets as the so-called DAX expert. So in fact, there's a highly competitive offering with a typical spread of 0.8 during the main trading hours here on the DAX, but also there's plenty of adaptations taking place right now. Also on the FX front with the reduced spreads here. Also here, feel free to check out the website from Admiral Markets. It's a highly competitive offering in the CFD and FX universe. And the thing is, in case of Admiral Markets, you're not trading with a broker who has only one office somewhere, but Admiral Markets has offices around the globe. So it's not only authorized and regulated by the FCA in London, having also, by the way, an office there, but it's also, for example, registered in Estonia or in Cyprus via the CISEC. They have also an office here in Germany, for example, in Berlin. But also they're, for example, located in Australia. So Admiral Markets Pty Limited here. So for further information on this, what this could probably mean for your trading, wherever you listen or read about Admiral Markets, feel free to check out the offering on their website. And this is the way you can contact Admiral then. And now we want to get started with our agenda for today, and also not only the agenda, but also then jump into the market. So the questions we want to answer today is, what the questions are, what are the key economic events in the coming trading week, but not only the next week, but also today. I already referred to what happened already, respectively, that we have around 1.5 hours from now, and then we have a very important employment situation report, the so-called non-farm payrolls being published. We want to answer the question, what's the current bias in the FX, equity, and commodity markets? So far, when you followed the price action over the last days, we can also answer this in a very short way already, even though we have to dig into, dig deeper into this matter and present some details on this. But current bias is most likely a risk-off bias. Look at equities today. So the DAX, for example, is up, significantly up. And that's very interesting to see because probably we have seen the bottom for at least some time, and the next week of trading could be that the advantage is found on the long side in equities then, and in this case especially in the DAX, especially if we make it above 660 to 680 on the upside, 10,660 to 680 points. So that's also something we want to have a deeper look into, and then we also want to answer the question, which trading opportunities may arise out of all of this. And so let's start here with a view on the market. Let's have a look here, in this case at Euro USD. Let's start with the DAX first and then focus on the FX markets. Probably that makes more sense here. So you can see the DAX here trading above 10,600 points. And the thing is, this is a daily chart. So we are still trading significantly below the 200 simple moving average here. With this purple line, you can see this, and this is usually, even though it's a rough indicator, but it's a good indicator to see that the overall mode in the DAX stays bearish as long as we trade below this 200 simple moving average, 200 in this case. Nevertheless, the thing is that we somehow look a little extended on the downside, and the market was capable of really withstanding further pressure resulting out of negative news hitting the wire over the first days of trading. So in fact, we had a very short week of trading in the DAX. So we had no trading on the 31st of December. That was Monday. But we also had no trading taking place on the 1st of January. So in the DAX, we only had Wednesday, the 2nd, yesterday, Thursday, that was the 3rd, and today, the 4th of January. So it's only 3 days of trading. Nevertheless, there was plenty of action being delivered and very, very interesting things being delivered, in fact, which weren't capable of pushing the DAX significantly lower. So there was, to some extent, it was good that over Christmas, for example, the DAX was closed on the 24th, on the 25th, and on the 26th. It was different from the US equity markets, who saw bigger volatility here. On 24th in the S&P, for example, S&P being significantly down, the highest ever measured on a Christmas Eve, and then retracing aggressively after 1 day off, the 25th of December, then pushing significantly higher. I already mentioned why that was. That was mainly due to the comments from Stephen Mnuchin here, talking to CEOs. It's like there's nothing to see here, and everything's fine. Just be sure that banks are well capitalized. They have enough liquidity. The only thing was no one asked for this information, and this is usually then the moment when you just wonder, okay, why do you tell us that there is no problem? Is there a problem? Is there something to be worried about? So it completely backfired here. And that was the reason, or that was the reason for the drop in the S&P on the 24th. And then, it aggressively bounced back. There was no aggressive buying taking place right from the start of the trading day, but in the afternoon, late afternoon here in Germany, in this case, then the plunge protection team stepped in and pushed the S&P, the Dow Jones, aggressively higher. There was nearly only one buyer in the market, and the thing is that again, it resulted in a very interesting opening in the DAX. It opened as if nothing had happened on the 24th and on the 26th. So in fact, the DAX nearly opened as it closed on the Friday before. And so in this context, it was very interesting that we started then the week of trading, or the new year here. In this case, 1 week later, we started with a short bounce on the downside. So when we're looking at the hourly chart, for example, you can see it here. So that was the second. When we came in, probably, let's zoom in probably a little here. So we came in aggressively sold back from around 10,660 to 680. That's why I mentioned this region earlier, because I consider this to be a quite significant region on the hourly chart here. And then, well, we stopped here, saw a bounce again. That was then over the next hours, mainly resulting out of the US price action. That was Wednesday. And then after hours, the market dropped again like a stone, over 100 points within minutes. The reason for that was that Apple, the big company in the US, cut their revenue outlook for the first time in almost 2 decades here, if I'm not mistaken. And the CEO, Tim Cook, pointed straight and directly to China here. And he said that there's a clear macroeconomic slowdown there, that this slowdown was almost entirely responsibly for the roughly around 10% drop in the revenue guidance. So it was a clear hint which was delivered there. So it's not only the Fed hiking rates, but it's the trade war initiated from the Trump administration, respectively Donald Trump himself. It's the trade war which is weighing heavily on the global economy, on China, and this backfires now to US companies. By the way, it's no big surprise. So everyone who has let's call it a rough understanding of economics and macroeconomics here, is not surprised by this development. And it was always, if you're talking to guys who have a macroeconomic background or traders in general, and you were talking to them, or discussing this here, the developments here around Trump, everyone was eye rolling. Everyone was just like, okay, I don't think that this guy really knows what he's doing there, or he knows it, and there's a plan he follows. He doesn't want to present to the broad audience here. Whatever it is, the thing is that it is all in all not very positive for the overall growth outlook here. That was something we could see yesterday in the ISM data for the first time, in my opinion, quite directly. But, and this is the thing now, before we come over and dig deeper into the ISM data here, the interesting thing we want to focus on here is what happened from a price action perspective in the DAX. So, in fact, this revenue outlook cut, which was communicated there Wednesday evening, respectively, in the first hours of trading on Thursday then, or the big volatility happening in FX markets after there was this big flash crash in the JPY, but also in other currency pairs like or currencies like the Australian dollar, for example. It did not have the big negative impact you would have probably expected. Yes, the DAX was down yesterday, that's true, and we kept on dropping, but nevertheless, we did not make it below 10,400 points. Even after the ISM data disappointed, as it did then, 4 p.m. German time in this case, it was CET, and there was this bigger drop in the Dow Jones. Even that was not capable of pushing the DAX below 10,400 points. And there was there was now today a quite sharp gap up. It was an untrue gap. It wasn't that we opened above the highs from yesterday, but we opened in the range around the highs from yesterday. So spot trading hours, and that's a very, very positive sign in my opinion. It's showing that very bad data or skepticism around the economy is right now more and more fully priced in and is not capable of pushing the DAX significantly lower. And this is one reason why I'm more and more optimistic for the upcoming week of trading, and could really imagine the DAX probably to at least to try to make it back above 10,660, 680 here, this region, and then take on further momentum. First target can be found around 10,850 points. I'm probably pushing higher from there. And interesting enough, when looking at the daily chart, you can see also that there is this upper trend line here on the upside from this channel. You can draw in the daily chart. So it wouldn't come as with a surprise if we start at least to trade back towards 11,000 points. I'm not saying that we make it above that level, break out of this channel and take on further momentum on the upside. So it could be that it's only a retest, but for short-term traders or for those trading in a lower time frame or on a lower time frame, I'm looking at the daily and seeing that there's no further pressure on the downside to take on, or further momentum taken on the downside. This is the first sign that probably we should switch here to long engagements on an intraday perspective, or at least reduce our short exposure here when taking aggressive positions on the short side here, because the momentum seems to diminish more and more. And this is my outlook for the upcoming week and for the DAX. So I can imagine here really that the market will take on some further momentum on the upside, even though we're still trading in a downtrend and we're still not in a very positive environment. But for the next week here, probably the DAX has a good chance to make back some of the losses of the last days here, or of the month of December in this case. So that's it on the DAX. Let's have a look then on Euro USD, or in general the currency markets. And there was also something really interesting happening. That was on already on Wednesday, in fact. So when we started the year, so FX markets, by the way, came to life also on the 2nd of January here. So there was a very, very interesting thing happening. Initially, the US dollar was under pressure, and there was still, or no, not still, there was some bid or some bids here pushing US yields lower, while European yields stayed stable for quite a while, let's say. And that resulted in a reduction of the yield differential between the euro and US yields in this case, pushing the euro up to 115, the region around 115. You can see this here. So we're talking about this candle. And then something interesting happened. In fact, German Bund yields here then nearly collapsed. They dropped like a stone to its lowest levels in almost 2 years. By the way, let me just do the following. 1 second. I've prepared the link here on a second screen, and I just realized that I haven't included it here in my links I prepared. So let's go from here. This is the tweet here from Wednesday then in this case, and this is 10-year Bund yields, and it's very interesting to see this drop here, because this is usually a sign of really markets having this risk off mode. Let's call it, and this drop here in yields. Yeah, right now it seems as if there was an anticipation, in fact, of the flash crash happening then in the hours to come. Then 10 hours later, we had this flash crash in the JPY. But the interesting thing, why this is noteworthy, is the following. So from the beginning of January onwards, the ECB halted their QE program. You may remember that there was this discussion taking place over nearly the whole year of 2018, and market participants played rate hikes from the ECB in the second half of 2019, quite aggressively. Not sure if I would call it like that, but they were definitely playing it. And the interesting thing now is usually what you expect, even though there was some anticipation, we know what would happen, but usually you expect yields to at least stabilize, if not trade higher, because there's now one big buyer less in the market. Probably only buy left in the market, the ECB here, and this is very interesting because yields, they behaved in a complete different way as you would have expected it by dropping. Usually expect the ECB to step back, and usually there's not usually, but there is a negative correlation between yields and treasuries, which means if treasuries rise, yields drop, and the other way around. So rising treasuries results out of the fact that there is demand which overcomes the supply. And now if this demand is significantly lower and the supply is higher, usually treasuries drop while yields start to rise. So the interesting thing is now this big buyer is out, the ECB, and yields drop. And this is usually something which is a clear sign of anxiety, of fear, of risk aversion around market participants, and something to be really scared about in the midterm in this case. So this might surprise you now, because I was optimistic for equities. Usually expect, based on such a risk-off mode, to be the skepticism around equities. I think that nevertheless, short term, probably equities can overcome this development here, and probably they profit from lower yields, because the rise in yields from October onwards was one of the reasons why equities in the US, but also in the European area, started to drop. So probably a short-term bounce is an option in this environment. Nevertheless, for midterm oriented traders, it's more like a sell the bounce environment in case of equities then, because this drop here is definitely worth noting, and it's also underlining that the overall positive outlook for the euro here is not as positive as I have drawn it over the last weeks here. So it's a neutral picture, but with this price action from Wednesday onwards, I'm really skeptical if we can hold significantly above 112. The only reason we now bounce back can be found in the also happening collapse of yields in US treasuries. So there we dropped below 2.6%, which is of high interest because at the beginning of October, we were trading in the region around 3.2, 3.3%, and at the highest level since 2011. And so this drop here in US yields is a clear sign that the market is switching to a overall. One second, please. Is switching to a risk-off mode here. So, and yes, so the drop in US yields is the main driver, in my opinion, here, why we are still trading around 114 in the Euro USD. And now the idea around the ISM data set comes into play, and why this is noteworthy. So I've prepared already here from Trading Economics a chart on the ISM manufacturing PMI. Let's go back for the 10 years, the last 10 years. So what we saw yesterday, this drop to 54.1 in December, that was obviously the lowest level since 2017, as you can see here, or the weakest since November 2016. In fact, that was when Trump was elected. And yeah, some might say, well, it's still above 50, and 50 is a threshold for expansion. So if we drop below 50, like several PMIs from China, for example, especially at the beginning of the or not, it wasn't the beginning, it was Wednesday, was this Caixin PMI, I think, or Caixin. I'm not really sure how to pronounce this, but it's focusing on small to mid sized companies focused on the export sector in China, and it dropped below 50, which is a clear sign that that there's a negative impact of trade wars taking place right now. So in this case, we might say, well, the purchase manager index here is still in a positive territory. But this is the thing, compared to last month in November, so that was numbers for December, in November, it was 59.3. And why is this noteworthy? Well, there was yesterday, there was a chart here from Nordea Markets in this case, pointing out that such a more than 5 points index, 5 index points drop on the downside in a month, usually only happened during times of recession here. In this case, that was the new economy, as I mentioned already at the beginning of this webinar, and there was here 2008, the last time that we dropped by 5 points. So I mean, it's only 2 data sets, so it's from a statistical standpoint here, it's not significant, but it's definitely something or it's noteworthy. And what's even more interesting is we have to remember ourselves here, the PMIs or the ISM data sets which are published, these are leading indicators. So it shows the expectation of managers here for the future. So it's a leading indicator. It's different from, for example, today's non-farm payrolls. This is a classic lagging indicator. They're looking at the developments around the employment situations for the last month in this case. And the interesting thing about this is if the optimism drops that aggressively, it's pointing to probably darker clouds at the horizon here, which we can already face. So this is a next clear sign that there's probably a recession coming, and something to worry about. Which brings us back to the non-farm payrolls from today. The non-farm payrolls today, they have all in all, first of all, when looking only at the numbers, they have a very good there's a high expectation in the markets now. After yesterday, ADP data came in at 271,000 here. They were expected to come in only at 178,000. So all in all, that was a number which was really, really strong. And what you can see here, that's something I prepared already, is you have in blue the ADP data set, and then in black the black dotted line, this shows the non-farm payrolls, and there is usually a high positive correlation, or put it differently and very straight. If ADP or not surprises, but if ADP comes in better than expected, you should expect also strong non-farm payrolls, for example. So all in all, we might now say, okay, then non-farm payrolls, probably the US dollar can make back some of its gains, losses from yesterday. And probably it's not the worst idea then to probably anticipate not only a good data set, but also position ourselves right now, US dollar long or Euro USD short, for example, or dollar JPY long after the flash crash lower. This is definitely something which could happen. And nevertheless, I wouldn't be really happy to position myself in the current market environment. And the reason for that is not only the ISM from yesterday, which is probably outweighing the non-farm payroll significance here. So there has been a time when non-farm payrolls were the event, because it was one thing to watch. Also around the potential monetary policy path from the Fed, where the to be expected monetary policy path from the Fed. But this has changed, since it's somehow a preset course or monetary policy path the Fed will follow now, and where the non-farm payrolls as a one as a employment report, or showing the situation in the employment sector right now, is not having enough or give us a significant enough event here to cause high volatility. But the outlook here, and that's why a leading indicator is probably even more interesting here. This is what's of interest right now. But there's also something else to be really skeptical about, and I'm not really sure if we have such a good chance to see a data set which comes in really significantly above the current expectation of 177,000. Yes, that was here. So this is the Forex calendar. You can find it on admiralmarkets.com. Go to analytics. They're in Forex calendar, and then you can filter the events. Obviously, you can see here, these are the events for the week to come, then the high impact events in this case. And today also here at non-farm payrolls now being published in around 1 hour from now, here with a forecast of 177,000. So now the interesting thing about this is, shall we really expect data coming in significantly above 200,000? Well, if you look at the last 8 to 9 years, be careful, because, and this is something else I prepared here, that's a hedge fund, a manager, hedge fund trader here, who pointed out something, or no, he retweeted something from a Reuters analyst here. So regarding the NFPs, and after a good data set yesterday around the ADP data set, he pointed out that this was the 8th time in the last 9 years that ADP has called for a December private job growth of at least 215,000. So we came in at 271. So beating minimum 250,000, which has been the minimum here over the last 9 years. So now in the previous 8 years, the ADP. So that's not counting this event yesterday here. So we have the previous 8 years, the ADP, which overstated actual BLS reported job growth, so non-farm payrolls, 7 times by an average of 76,000. What does this mean? That means nothing more than it wouldn't be such a big surprise to see numbers for non-farm payrolls coming in 76,000, probably even more than that, below what yesterday was published around the 271,000 of the ADP data sets, which was published, which means nothing more than when you expect the non-farm payrolls at 177,000 and you see the number here for ADP yesterday coming in at 271,000, you subtract 76,000, you come out at 195,000. And with this in mind, then you're all already somewhere in the region of the forecast here, which is not such a big surprise. And in the current market environment, something to be really skeptical about if this could trigger a bullish weekly close for the US dollar. So be really, really careful about being overly optimistic for the US dollar after the ADPs that I said yesterday, because the ISM reading was so catastrophic, and somehow you could really feel it when also following social media channels like Twitter or something. You could really feel that let's put it that way. So traders or market participants in general were skeptical already, but this yesterday, that was like a crack. That was a real crack. You could really hear it, or at least read it, and it was like, okay, so I think we are in trouble. That was somehow the feeling you got out of this, and it shows that probably NFPs today are not as volatile as you may have expected, where you may have seen it in the past. And probably the numbers itself are really, they don't count really, because what's more of interest is what happened here around the ISM yesterday. So all in all, the outlook or the optimism around the US dollar, I think you should be really, really careful about that. So with this in mind, by the way, and my skepticism around the euro, that's also something I'd like to mention here, why I'm still skeptical about the euro. That has also something to do with the fact around GBP. So also pound sterling saw aggressive push on the downside during this flash crash happening here. So also pound was highly volatile and very, very illiquid during this flash crash. The thing is that we spiked here below 125 and are now trading back to the nearly opening price of 127.50 around here in pound sterling. So this looks still fine and is similar to the picture in the euro, but we should always keep in mind that this Brexit vote is still on the table. It won't take place next week. It will take place on the 14th of January. Now the question is, will it really take place? Because there is now also speculation rising that probably there will be another delay of the vote here from Theresa May, because it's still not clear if she can win her vote on her Brexit deal she negotiated with the EU, and which was, by the way, already signed by the EU. And so with this in mind, there's still it's still not clear whether we should really expect high volatility in the week to come, but also enough optimism coming up, pushing pound sterling higher, respectively, in this case also the euro higher, because we remember there's this tight band, let's say, or this big connection in terms of trade between the UK and especially Germany. And so with this in mind, the thing is that we should be somehow a little skeptical if moves on the upside, if they happen at all, are sustainable, or if it's not probably now the case that we are about to probably rather sooner or later, especially if this Brexit vote is delayed another time, and then the UK and especially Theresa May in this case, running out of time to get a deal done before the deadline at the end of March. So with this in mind, I think skepticism is definitely something to be it's something to have it in mind in terms of engagements against the US dollar. So if you plan to play the downside in the US dollar, probably the euro, but also pound sterling are not the places to be, or shouldn't be the first choice, in my personal opinion. But probably the best choice is the JPY, which has seen tremendous volatility here on Wednesday. So in this context, I highly recommend watching or checking out the website from Admiral Markets here, and there the analytics tab and traders block. So yesterday there was a fantastic article on the flash crash and what happened. So you can see here, by the way, it's not only around the flash crash here, but also today there is an article with a focus on the NFPs, and some of the thoughts presented within this article can also be found here now in this article, sure, in a written way. But first of all, let's focus on the flash crash and what hit markets there and what happened especially there. So there's this flash crash, and so the question surely arose here: what caused the JPY flash crash? So first of all, it was the already mentioned Apple news here, the revenue outlook cut, which was after markets, and which in a very, very tense environment resulted in further and accelerating tensions here, skepticism. And usually you see market participants then unwinding their carry trades, which means they usually a carry trade, you finance it in low yield or zero yield currency. And this case, the JPY is the place to be, beside the Swiss franc in this case, by the way. And that was one of the reasons why we saw the flash crash there, because now there was huge supply coming into the market, where it's especially demand, and market participants unwinding their carry trades bought back aggressively JPY. The thing is that there was not enough supply in terms of JPY at this time, which then pushed the market aggressively lower. And low liquidity in this case was triggered by also different aspects here, or played a very important role. It's not only that that was in a time frame when we had the rollover, or the so-called death window, or dead window. Sorry, not death window, dead window. Here, so that was around the opening in New Zealand, Auckland. Nevertheless, Japanese markets were still asleep, respectively, weren't expected or shouldn't expect to be open the whole day, since yesterday was a bank holiday in Japan. So the unofficial start into the year of 2019 in Japan is in fact next week on Monday. So this also triggered low liquidity, and so all this in combination then triggered this aggressive demand in JPY, resulted in this flash crash and pushing dollar JPY in this case, for example, to its lowest levels since March 2018. So now we've already seen this aggressive bounce back. Nevertheless, the thing is that there's still the advantage to be found on the short side, in my opinion. That has been the case for quite a while after a dollar JPY failed here to push back towards 114, or stabilize above 114. So I think, or this is what I would look for. Let's put it that way. So if NFPs come in better than expected, I think then we have a chance to probably see a weekly close above 108 in dollar JPY. And we shouldn't underestimate the fact that the Bank of Japan, for example, is also not really happy about a too strong JPY. And probably even they haven't yet done so, but chances are good that probably in the days to come, there will be an announcement which clearly hints towards an intervention, or they try to down talk the JPY in some way. So this could also accelerate a move higher here. And by the way, also trigger further bullishness in equity markets, because you have to understand that such an intervention means more liquidity. In which way in which way we don't know yet, but it means more liquidity. It's similar to what was also mentioned by the Chinese central bank, the PBOC, cutting the reserve ratio in the morning by one PPT. By one PPT in this case. So the thing is, all this could result in a short-term bounce in equities, and in this case, by the way, also pushing the JPY lower and resulting in a push back towards 109, probably above 109. Optimists probably see a push back towards 110, but nevertheless, I think there's a good chance that after such a push higher in dollar JPY, if there's a sign of weakness, such a bounce on the upside here should be probably sold. And there's a good chance that we haven't yet seen dollar JPY trading to as low as 105 the last time. So I could really imagine that from here, there will be another stint back to these lows around 105 in the, not necessarily days to come, but weeks to come in the overall environment in which we find ourselves in. And so with this, we close the cycle. I think that dollar JPY in this case is, or JPY is an attractive currency in the current environment to consider as a currency to trade long against the US dollar. We plan to short based on several developments taking place right now around the US dollar. And by the way, then this is the final picture we want to have a look at here. We also have to look at a gold. Usually there's a negative correlation between gold and the US dollar. So which means if you're skeptical, especially midterm around the US dollar, being long gold is a very, very attractive place to be, in fact. And even if non-farm payrolls today can support the gold, the US dollar to some extent, if this really happens, numbers come in really above 200,000, for example, and average hourly earnings are beating expectations, something positive, which is probably taking some pressure off the US dollar right now, and resulting in a rebound in US yields. If this is happening, this could also trigger a pullback in gold, which looks a little extended here, but you have to keep the following in mind. It's not only that gold is attractive from a long side based on the outlook for not so positive outlook for the US dollar, but also from a seasonal perspective. And in this context, I've prepared something here. Oh, sorry, by the way, it's here. It's a seasonal pattern, which says that over the last 20 years, and by the way, let me just do it that way, probably a little better. This, and then we go for 20. So in the last 20 years, that was during the 7th till the 18th of January. Monday is the 7th, by the way. It has been in 15 years the case. So 75% in this case, 15 years, with a profit of 22 USD per ounce around. While in those 5 years where gold didn't profit, and in fact dropped within this time span here, it only lost 10 or around 11 USD per ounce. And the max drawdown here in this time span was 23. So this seasonal pattern starts from Monday and is then valid for the next around 2 weeks of trading. And even though the outlook for gold is extended from a technical perspective, so it really looks extended here, nevertheless, it's not sad that we can see a quite aggressive push up to and a really trend stable push, or the trend continuing higher here. Above 1,300 USD here within the next 2 weeks, because again, seasonality and also the current bias in the markets, risk off mode, is usually favoring a gold strength in this case. Then, yeah, and so that's it from my end around the non-farm payrolls and also the outlook for the next week of trading. Many of my thoughts here can be found on the website from Admiral Markets here too. On Monday in the Traders Block section in written format, we'll have our weekly market outlook there too, giving also some ideas again around not only what could be could drive markets higher, but also, for example, again, those lines here around this seasonal pattern then also being published in this article. And yeah, so that's it from my end. So I wish you happy weekend. Enjoy yourself, and talk to you again then next week on Friday, the 11th of January. I wish you all the best. have a nice weekend, and talk to you again then next week. If you have any questions, please feel free to shoot an email over to Admiral Markets. And yeah, again, that's it from my end. So have a nice day. See you. Talk to you soon, and bye-bye.